Let's start our first panel. I'd like to welcome to the stage Jason Moser, Andy Cross, Emily Flippen, and Bill Mann. Please come on up, and let's get to our first poll. We'd like to get a sense of how you all are feeling about the market. So which of the following statements best characterizes your feelings about the current stock market? You can't stand to look, feeling a little bearish, feeling bullish, or you're one of those wonderful maniacs who is all in no matter what. Don't feel the peer pressure. Don't go ahead and vote the way you were going to vote. Don't let the fact that we're calculating this in real time affect how you actually feel about the market. Where is the poll in the app? Andy says there's a resolution desk for that. So you can tell that Andy and I are real technical wizards. All right, why don't we close off, and I think we're all pretty pleased to see, for those who voted overwhelmingly, people feeling good about the market. Before we get to questions from you all, I want to talk to the folks up here about sort of where we are in the market, sort of get a sense of your headline. And Andy, since you made the mistake of sitting closest to me, I'm going to go to you first. What is your headline for the market right now when you look out at what's happening? And certainly this comes in the wake of a pretty memorable December for most investors.
Yeah, I think that's a good point, Chris. When I think about the markets, and I talked to some of you yesterday about this, the last 10 years has been exceptional in the U.S. Bill mentioned this in his opening remarks. Certainly, I am excited and bullish to invest over the next 10 years. I don't think we can expect to see those kinds of returns again from the lows of 2008, 2009. However, I think the investing in businesses that can generate exceptional long-term returns through businesses that have economic advantages remains the best way to be able to create wealth globally. And I think the Global Partners team is finding those pockets internationally with companies that exhibit those characteristics, and certainly in our services in the US, we do that as well, I believe, and it's certainly been recognized over the last few years. So I think the returns are still out there. I do think volatility, certainly of like what we saw in December and the Q4 of last year, is back. That's not a surprise. Investors really have to understand their own temperament to be able to succeed as long-term investors and take those opportunities when they can deploy capital very quickly, maybe having some more cash on the sidelines, maybe being a little bit more optimistic. So long-term investment returns through equities is still the best way to generate wealth. I just think it'll come with much more volatility over the next 5-10 years.
Emily, what about you? What's your headline for the market?
I agree, and I'm actually going to challenge something Bill said when he was stating his opening remarks, saying that the U.S. is an amazing market to invest in, and it's true. I mean, I'm not going to peddle to the U.S., but I will say that the U.S. is an amazing market. A lot of the companies that we see in the U.S. are international companies. They do business everywhere. But here's what's exciting to me as an investor. When I look back over the past few decades, I mean, the U.S. was the place to be. But now I'm looking, and I'm seeing population growth in the US that would be declining if it weren't for immigration. And I wonder, are there better markets out there to deploy my capital in? And we haven't seen the returns in international markets like we've seen in the US. But I think over the next 10, 20, 30 years, and being a long-term investor, I think I should really be doing more involvement and investing in international markets. I mean, Vanguard recently came out and stated that they decreased their US equity predictions, the return for US equities over the next 10 years to about 5%. And a lot of that's attributable to the amazing bull run we've had over the past decade. So it's not really unexpected. But to me, that makes me think there's so much opportunity out there that so many people are afraid to take simply because they're American and they have a very home-set bias in their investment. So for me, the biggest thing in the market right now is really looking at international growth opportunities.
Jason?
Yeah, just
I don't want to put any pressure on you, but I'm really hoping you're going to also disagree with something Bill
I'm
said.
not going to actually disagree with.
Just warming up with that.
I was not going to pile on to Bill. Actually, Bill said something I thought that was really astute in that a lot of these international markets, they're just starting to develop. And the reason why we maybe don't have them top of list is because they're sometimes 10 to 15 years behind what we're doing here. I mean, I can certainly testify to that. I mean, having had the opportunity to live in Cairo, Egypt for 3 years, Kazakhstan for another 2, interesting places in their own right, but you would see consumer behavior.
Ish years behind.
Yeah, I mean, everything they're doing, they're just kind of catching up. They're getting the things that we're getting. It's just later. And so you can certainly see the opportunities exist there. They're just a little bit behind what we're doing. And to your point, we kind of just focus on what we know and keep inside our little box here. Most people, it doesn't seem, have that opportunity to travel or don't travel, so they don't realize what actually is going on in that big world out there.
And one of the amazing things, one of the things that Jason talks about that I love is the war on cash and the companies that are benefiting from people no longer carrying cash in their wallets and using many more different technologies for transactions. And if you think that that's happened quickly here in places like Egypt and Kazakhstan and Kenya, they're literally skipping cash. They've gone from having, their first step out of poverty in a lot of ways is carrying a device that is not cash that they do for transactions.
Yeah, they're loving it. I mean, they went literally from nothing but cash to trying to figure out a way to get rid of all their cash. And when you're in Egypt and you have the piaster to go with the pound, I mean, the piaster is essentially their version of a penny, and it's paper money. So you can imagine how carrying around 1,000 piasters a day doesn't really work out so well. I have a proclivity, I guess, to be a little bit more glass half empty most times. I'm really working on trying to be glass half full. But when we talk about the state of the market today and where we are as an economy, I can't help but feel like maybe we are closer than further away to a recession. Now, I mean, to me, the recession is irrelevant. I mean, it's a matter of when, really, not if. But, we had a lot of conversations yesterday, people talking about the market's valuation, how much cash do you have? I thought about it. I didn't really have a pinpoint number I could give. I estimated it was around 20. I went through and calculated it last night. It's more like 15% cash of my overall investment portfolio. But I think there are some reasons to at least be a little bit concerned. I mean, a couple of things that stand out to me. Obviously, the student debt levels, that really is a crisis, I think, at this point. We're talking about $1.5 trillion, 90% of which is essentially guaranteed by the U.S. Department of Education. That money doesn't just disappear. We don't just write it off. This isn't Seinfeld. And then another data point.
Wait. Is this your glass half full speech?
No, this is the glass half empty. I was just trying to make sense of it all to say that I'm working on it. I'm working on it.
This is his 20% full.
I'm working on it, folks. Please. I'm still invested. Glass half full would be like 10% cash. I read another interesting data point the other day that a record 7 million plus Americans are at least 90 days delinquent on their auto loans. Now, as an overall percentage of borrowers, that's still a little bit lower than the peak during the Great Recession. But, I mean, it's also worth noting, we're talking about cars here, people, not houses. If you're having trouble affording a car loan, I think there may be some problems there. And then when you look at what FICO has been doing to make people's credit scores better, to give them the opportunity to have a better credit score, we have a record pool of borrowers with better credit scores than ever. And obviously we're in a very good employment situation, but it does seem like wages aren't quite keeping up. And when you have a young borrowing pool with a lot of student debt outstanding, at some point or another, you got to pay the pipers. I think those are things just to keep in mind. But for the rest of the event here today, I will be more glass half full, I promise.
Well, one of the things that Jason said that I think is something that we should all be mindful of is that level of student debt, in some ways, to me, is not existential. It's an enormous crisis in the United States for one very specific reason. One of the reasons that we have the most dynamic economy in the world and one of the largest stock market in the world is that we have an entrepreneurial culture. And what happens when you have so many students with so much student debt is that entrepreneurialism really becomes the province of the rich. If you come out of college and some people have $250,000, $300,000 in college debt now. I know this because I have one child in college and I'm about to have another one, so I may join them. But
In college, you may join them, or?
I may join them, yeah. Yeah, I'd love to learn how to read someday. But all this to say that when you have such a large percentage of very talented people who become debtors that they can't discharge, it's really, I think it's a really enormous risk for the U.S. economy.
Well, here's the thing. We're sitting here at a global partners summit, in a sense, and we're sitting here talking about development in the U.S. economy. And so is this just a testament to the people on the panel and the audience that maybe this is a sign that, we have all of these concerns about the development of the American economy? Does this make you more, or less hesitant to continue to expand your international holdings? Because sure, we have people who are guaranteed to be underwater on their car loans, an entire generation of Americans that are burdened by student debt, which is going to hurt entrepreneurism. So maybe what we do is we then look outside of the US to return those same improvements that we've seen over the past 10 or 20 years. And I realize I'm hitting everybody over the head with this pretty strong here. But for people who are so interested in global companies, and I would imagine that's the vast majority of people here in the audience, we're still so concerned about the American economy. And you saw it in that poll that, Chris, you started out with. Some people are very, very bearish, but that's not to say that there's not amazing opportunities if we just step a little outside of our comfort zone.
Before Emily hits me over the head anymore, actually, my biggest concern's in China. I said this yesterday. When you talk about debt levels and what's happening over in the Chinese economy and with their consumer base, and with a government that continues to get more and more authoritarian, with China 2025, what they're trying to do from controlling more of the influencing directly more in the corporation and continuing to leverage up that economy, like what we saw in January. To me, that is the biggest concern to the global economy, including to the U.S. companies and how they react to China. So for me, it's actually not the U.S. consumer. I appreciate the debt in the U.S., but I think to Bill's point, the U.S. Innovator, the entrepreneur, I believe, even though we haven't seen nearly as many company formations over the years, I still believe in the American entrepreneur. And while China has an extremely demographic situation and continues to invest in technology, it's so much driven by the state. And that worries me over the time period, both for US companies and for Chinese companies as well.
Well, I'm going to take this opportunity to make a quick plug for Ben and I's breakout session, because we're going to talk a lot about what Andy just covered, but to not delve into it too much, but to say for the Chinese economy, the mindset that the average Chinese person has is a much longer mindset, I think, than American has. And America is such a consumerist society, and China's really just barely dipping their toes into the water. So for me, some of the trends that we're seeing don't concern me over the long term, because like you said, you're looking at a country that maybe is developing 15 years behind the US, and to me it's not anything different than what we saw developing here in the US that maybe investors 15 years ago would have been concerned about in the US.
Yeah, I think maybe we need to figure out a way to at times separate the concern about the American economy with the opportunities that exist globally, because we could sit there and say, we're talking about being between a rock and a hard place here, but to your point earlier, a lot of those great businesses that are domiciled here are really global businesses at this point. Whether it's Starbucks or Apple or Amazon, we're talking about companies that are all over the world making money everywhere. So even though we're talking about domestic challenges here, those businesses are certainly a bit more immune to it because they're so well diversified and so global. On the flip side of the coin, you have a company like Mercado Libre, and I know Bill's talked about this before, the emergence of the middle class on a global scale in Latin America, I think, is where one of the bigger opportunities has emerged, and I think that's why Mercado Libre has done so well for so long, because there's a middle class emerging in Latin America, and that consumer is becoming more and more powerful over time. So you can kind of have your cake and eat it too in that regard. I think it's just being able to separate the conversation from the domestic challenges and recognizing that some of these domestic companies are still very global in nature.
We're going to get to some specific stocks in just a moment. Again, questions are starting to come in on the app, whether it's taking a poll or submitting questions for Emily's breakout, Bill's breakout, Jason's breakout later today, or this session today. Simply just click on the event schedule, and then if you go into the individual session, that's how you're able to ask questions and answer the poll questions. Before we get to some of the questions that are coming in, Andy, I'll just start with you. Let's talk specific stocks for a second. What is a stock that is not currently in the Motley Fool universe that is either on your watch list or something you find pretty intriguing right now?
Yeah, so ironically, even though this is a global panel, the stock that I've been looking at and talking to one of our analysts, John Rotanti, about a little bit is almost all in the U.S. In fact, I think they exclusively in the U.S., and that's O'Reilly Automotive. It's a $30 billion auto parts retailer. And we drive, in the U.S., we drive about 3.2 trillion miles per year across our roads. And the cars continue to get older and older, and O'Reilly Automotive, through more than almost 5,300 stores across almost all the states in America, provide a service to the do-it-yourself car mechanic, essentially. And their growth, their record of growth is exceptional. They've been able to grow their same-store sales more than 26 straight years. Their revenues, they're basically comp stores grow at 3 to 5% per year. Their sales grow at 6 to 10%. Their earnings per share grow more than 10% or 15% for a decade. And they just continue to reinvest in their stores, buy back lots of stock. It's a very consistent stock, O'Reilly Automotive at $30 billion. They lever up the balance sheet at the right times and make little acquisitions. So it's a non-global company per se that doesn't operate in the global, but it certainly has global supply chain issues because so much of their parts come from around the world. So it's globally tied. It's just that all of its revenue is generated in the U.S. So it's ORLY, O'Reilly Automotive.
Can I ask you a quick question?
No. I know nothing about it. Yes, go ahead, please.
I was having a great conversation, and I apologize in advance. I cannot remember for the life of me the name of the member who I was having this conversation with. But we were talking last night about Amazon and the potential for Amazon to be moving into the auto parts manufacturing or distributing. So does that change if Amazon were to tomorrow get into this business? Would that change your opinion about O'Reilly?
I'm probably more bullish. I imagine the stock will get clobbered probably 15%, and I think that's a good buying opportunity. Jason's talked a little bit about this in retail.
I think that would have fit very well with our conversation yesterday.
Yeah, I think O'Reilly is actually they have this really deep network that they continue to invest into, and that actually gives them an advantage over the likes of other superior e-commerce businesses like Amazon. So I think that would actually be an opportunity to buy the stock.
Not to be a conspiracy theorist, but don't you think it would be great if Amazon had a venture arm where they would short companies and then say, yeah, we're thinking about getting into their business?
I think the SEC may have something to say about that.
Auto parts seems great. And then they close their shorts and do something else.
Amazon Investment Services.
There's going to be a breakout on Amazon Investment Services.
You're assuming they don't do that already, Bill.
Before the lawyers break in, Emily, what about you? What's a stock on your watch list?
I realize this is going to be ironic after all I've been talking about, these international opportunities, and I'll have plenty more stock ideas. You come to the breakout. But the company that I'm interested in today, it's a US-based company. Its name is Tenable. The ticker is TENB. And I'm really excited. It's kind of an old company. It's been around for a couple decades, but it's a new IPO, and they're doing a lot in the works of cybersecurity here in the US. So you look at a lot of these SaaS companies that seem to be doing it all, right? And one of the small parts of their businesses is, kind of managing a company's cybersecurity. But cybersecurity is all Tenable does. And they have numerous products, from their original product called Nessus up to an enterprise version that they're now selling to organizations. And they are much more in-depth and thorough in the work that they do in cybersecurity than virtually any of their competitors. A lot of competitors right now in the cybersecurity field, they're reactive. They'd be like, oh, a breach has occurred, this is what you need to do. They'll have professionals. They're called penetration testers. They come in maybe once a year, once a quarter. They look for vulnerabilities, and they tell organizations, okay, this is what you need to do. Tenable doesn't do that. It's almost like having a drone that constantly monitors your organization and lets you know immediately when a breach has occurred. And that's invaluable in the climate that we're seeing, especially in the United States, but internationally today. Companies are no longer able to stick their heads in the sand about their cybersecurity vulnerabilities. We, as consumers, demand privacy, demand security. And so it's a hard sell. It's a hard sell to people who don't have a chief information security officer to say, hey, you need to spend the money for a service like Tenable's, enterprise service. But companies that are aware, they love the product, they need the product, and I just see such a big market there for Tenable.
Jason?
Yeah, I too am going with an American company, and I
What
apologize.
is wrong with you people?
I apologize for nothing. All right. It's difficult to find a company that is not in our universe at this point. I feel like we've identified a lot of the great businesses out there, but there are companies that exist, and I'm sure a lot of you have probably heard me talk about Ameris Bancorp before. This is just a little small cap Georgia bank, about a $2 billion market cap. One that
Not Republic of Georgia, the state of Georgia.
I discovered it back in 2011 as the FDIC was kind of going through the country and trying to clean up the mess from the financial crisis. And Ameris, thankfully, was a relatively conservatively managed bank. They kept a good balance sheet. Their capital ratios were all healthy. And so the FDIC saw it fit to use Ameris as a partner in rolling up a lot of these failed institutions with essentially a risk-free acquisition strategy. Ameris got all the deposits and all the assets and really none of the risk. And so it helped them build up the bank pretty quickly in a short period of time. And fast forward to today, and they've grown into a bank with about $15 or $16 billion in assets. They just announced an acquisition of Fidelity Bank in Atlanta. It's getting them a lot of exposure to the commercial real estate market in Atlanta and Orlando. So they've become a very wide-reaching southeastern regional bank. And I was telling Joy and Neil out there, wherever you are, I was in Greenville recently and went down to Spartanburg to go speak at Wofford College. Go Terriers! Won again last night, Bill. Won again last night. And I saw, an Ameris just right there in downtown Greenville, and I just got a nice little warm and fuzzy as a shareholder. I thought these guys are doing okay. This is a foolish company. I had the opportunity to interview the CEO of the company recently, Dennis Zember, on Industry Focus, and I was maybe not surprised, but very impressed about his focus on culture and the type of business they're looking to build, where employees are proud to be, where they're happy to be. It sounded very familiar. I think we have a lot of those same qualities in Motley Fool. And it goes to show that you can be a bank and you can still be doing good things. And I think that what they've done over the course of time is prove that they can be a well-managed bank and grow slowly without trying to be greedy. And he did make the point that during the financial crisis, they learned a lot. And a lot of the lessons that really came from that was the value in being conservatively managed going into that firestorm. Just like I'm sure a lot of us learned a lot from that period as well as investors. So it struck a chord. But it's a neat little southeastern regional bank that's continuing to grow. And at $2 billion, I think it offers a pretty compelling growth story for investors. The ticker is ABCB.
Bill?
Let's talk about our future robot overlords for a second. And it's actually a foreign company. It's called Fanuc. It's based in Japan. The ticker on the US is FANUY. And they are one of the 4 main companies that make robotics for construction. They do auto manufacturing. When you hear about Elon Musk saying that they're getting all of the automation in the Tesla superfactory, down to gigafactory. I'm sorry, I understated Elon Musk, which you should never do.
Wait, I think I just saw a tweet about this.
Have you guys ever thought about the fact that Elon Musk basically has all the tools to be the perfect real-life supervillain? Like, he's got a tunneling company, he's got, flamethrowers, like, he's perfect.
You're saying he's not already?
I'm saying that if it turned out that was actually what he was going for, he has nailed it. So Fanuc is a Japanese robotics company, and let's talk about their culture because it is bizarre. It is really something really great in certain ways and weird in others. About 20 years ago, the president of Fanuc got rid of everyone's email. He got rid of all of their website. There is nothing connecting Fanuc operations with the outside world. It's kind of like the North Korea of robot companies. And the reason why he did that, he said, I believe in the next 20 years, we are going to find that the Chinese government is going to try and steal everything of value from anyone everywhere. And so I want everything done by fax. I want everything done by pen. All of our development is going to happen in a closed environment. And that's what they've done. And by the way, they are now the best operating of all of the robot companies because their technology has not been stolen. They have some of the coolest, is that my phone? Is that your phone? Yeah, sorry. My wife calls it always the worst times. So it is a wonderful, very well-run company, and it's in an industry where there are basically 4 large participants. I happen to think it is the best and the cheapest of them, but it's an industry that really nobody else is going to be able to break into at the scale where they are. One of the coolest things about Fanuc, let me just add, is that it's a robot company, so they build robots, and they designed robots to build the robots that they sell. So.
Let's get to some of the questions from the audience. Andy, this one's for you. What do you think will be the impact of electric vehicles on auto parts suppliers?
Well, I think as cars get more and more complex and people either have to spend the money to have mechanics fix them, or they get more sophisticated to try to fix it themselves, I think as the market shifts, the do-it-yourself, as cars age and then we shift over to more electric vehicles, I think there's still a do-it-yourself market that the likes of someone O'Reilly has been doing this since 1957 will be able to take advantage of. It'll be very interesting as the car parts continue to get more and more sophisticated. You just look at what's involved with a Tesla and how we think about fixing some of those and keeping our companies up to date. So it's probably a long-term challenge for O'Reilly, but I don't see it as something that would completely disrupt their business over time.
Jason, I think this one's for you. Can banks come back in this rate environment?
Did they ever really go anywhere?
I mean, some of them did.
Some of them did.
Some of them did. I mean, I think that's a good point. I mean, right now we're certainly seeing in this rate environment a lot of banks out there competing for those deposits and essentially, paying up for those deposits in the hope that the rate environment eventually comes back and they can make a little bit more money on those deposits. I do think at some point, rates have to inch back upward even just a smidge. But with that said, I mean, banks definitely have made a living in this type of environment before, and I think the market tends to reward banks that are well run, and they do have a track record of investing those deposits effectively. And that really, at the end of the day, I mean, a bank to me is much like an insurance company. I mean, insurance companies are doing what they can with that float. Banks are doing what they can with that deposit base. And so that is where size really does kind of matter. And the bigger you can get that deposit base, the more you can do stuff with it. So generally speaking, yeah, I think they can still do it.
Programming note, if you don't know Q2 Software, it's a company Bill and I have followed for a while. We'll be talking to Matt Flake, who's the CEO. Q2's headquartered right here in Austin. And we'll be talking to him later this afternoon, so we can ask him some good questions about the banking industry.
Bill, I'm going to send this your way. Which global organizations or companies should we avoid? Keep in mind, we've talked many times before about sort of emerging markets being an opportunity. I mean, the last couple of months have been good, not just for the S&P 500 and the Dow, but the MSCI emerging markets as well.
Can I get away with just saying Venezuela and we move on?
I think
No.
I think we all had that.
You're not wrong.
That's right. Yeah, I don't think people are wrong about Venezuela. I think one of the things that people tend to do, and we'll talk about this later in my breakout, so I'll spoil some of this now, is that they think that because something has underperformed, that there is some sort of natural law that that forces it to come back. There are countries out there that really have no culture of actually taking care of shareholders. Maybe in the United States we're a little bit too far the other direction. But if you look at what has happened, for example, in Italy over the last 30 years, they have destroyed capital. It really, really, you have to wonder what capital did to make Italy so mad at it. It's destroyed so much capital. So I would not get very excited about looking at a lot of countries that are cheap and thinking that there's some natural law that they will come back.
Can I just pivot on that a little bit, and something Emily mentioned when she talked about the Vanguard stat is I think one thing that we're talking about with international investing, the reason why I'm excited for the Global Partners Initiative is it's stock by stock. It's not, we're not, as far as I know, and we have no plans to do ETFs or index funds where you buy a big basket of ETFs that are skewed one way or the other towards the largest market industries. What we're doing is trying to find those investment opportunities, and the team did it this week with really finding some fun companies that are in different markets. And that's what we're doing. So it's not just going in and buying a country that looks like it's low on a PE basis and buying some ETF that you will see from so many financial planners when they say, hey, get international exposure. It's just much different what we're doing, and I think it's much more fun, and it will end up ultimately being much more lucrative as well.
That's a super good point. So people who I met with yesterday, a couple have asked me what one of my favorite companies in the world was, and I said, you're not going to believe this, but it's a Russian bank. And it's not because I'm particularly excited about Russia, because I'm not, but it happens to be one of the best run banks in the world, and it's called Sibir Bank. And so on a company by company basis, you can find really good opportunities in places where you naturally would be disinclined to invest.
One last question before we wrap up, and I'll just throw this out for whoever wants to take it. What is your view on investing in the marijuana industry?
Well, I feel like I should probably be the first to speak on that. I do work on our marijuana portfolio, so I'm relatively new to it. And I will have to say, when I first heard that the Motley Fool was getting involved, I was very skeptical.
We're not in like distribution or anything.
No, okay, we're
in marijuana.
lightly involved, investing in some companies who may be involved. But
moving product.
Exactly.
Yeah.
You know, I spent a lot of my time looking at growth industries, and I had written off the marijuana industry because it is full of, and I don't want to say fraud, because I've said this before, but it feels like a very strong word. I think it's full of ignorance. I think there are a lot of people running companies in the marijuana industry right now who have no business running companies. But it's kind of the ultimate growth industry, and the Motley Fool has done a great job of not only training me, but training members to see the marijuana industry as a great play on a basket approach. So I think if you are a prudent investor who can avoid a lot of the typical pitfalls that we see with people who may invest in marijuana stocks, it can be an exciting industry to get into. And I will just add in, and this applies not only to the marijuana industry, but to all international companies as well. You can be right about an idea and wrong about the timing. So it's important to understand what's driving that business and what's going to make that business, or what's going to take to make that business succeed over the long term. So you might have a great idea. You might think a company, whether it's in the marijuana space or the international space, you might think it's a great company, but you need to identify the drivers that are going to make that a realizable investment for you and your portfolio before you jump in.
Tom Gardner loves playing a game, so I'm going to play it right now, and which is to make an opinion and make it a strongly held opinion absent any evidence whatsoever. So it's a fun, completely irresponsible game. I'm going to play it in front of you right now. I think the company that's going to win in the marijuana industry is Philip Morris. I think ultimately, I'm not kidding. I'm really not.
Definitely true.
They bought part of Juul, and I think ultimately they're going to find the competent players in the marijuana industry, and they're going to use the rivers of cash that they have, and they're going to start buying some of the best ones.
Sorry. Are you done?
No, go right ahead.
I was going to say this.
Just interrupt me. It's fine.
I'm sorry. You got to love this about an industry that you get see a headline like this from CNBC. Martha Stewart had some help on her CBD deal with weed grower Canopy, Snoop Dogg.
Well, they have like some cooking show together, right? I mean, they've developed an interesting relationship.
Those are the headlines that long-term investors.
What a time to be alive.
Day in and day out.
Well, but so you hit an important point there, because I mean, we see this with all sorts of new market opportunities. I mean, I think crypto was very similar. I mean, when you see something totally new and really to this point yet fully unknown, I mean, people are still trying to figure out how crypto works. people are certainly still trying to figure out what the opportunities in marijuana are, especially given the fact that the legislative outlook here domestically is still extremely unclear. I mean, I think ultimately it's going in one direction, and we all know what direction that is. But you look to something like Canada, and you can see when the legislative environment becomes a bit more understandable, then what the opportunities that exist are. But when you see these new markets, and they develop those types of headlines, and people get really excited. And so then they just start plowing money into it, left and right, hand over fist, can't put enough money into it. Good ideas and bad. It's just this big river of cash that goes into all of these companies, good ones, bad ones, in between. And that's the problem right now, is you've got this mania where all of this money is going into this market, regardless of whether it's a good idea or not. It's pushing the valuation on all of these businesses up. Some of these businesses are truly houses of cards. Some of them are okay. But to your point, in looking at these companies like Philip Morris, Constellation Brands, we know they've made investments there. Looking at some of those bigger companies that have the resources to place small bets early on to see how this might shake out is probably the better way to start. And then to Emily's point, learning about the drivers of the industry, learning about the companies that are really leading the way and taking advantage of that and actually making money. You have to be aware of the mania when you go into new markets like this.
Yeah, some of those businesses will undoubtedly go up in smoke.
Ooh, man,
Seems like a perfect time to wrap up and say goodbye. Andy Cross, Emily Flippen, Jason Moser, Bill Mann.